Welcome back. Well, a topic that has become very popular among various market and financial channels is the idea of a reverse market crash. So, we're going to dive into this concept and see how it applies to today's financial markets. Now, these are two examples of channels that have discussed this very recently. Both really great videos. We'll provide links for these in the notes as well. It defines a reverse market crash is as follows. While traditional market crashes are characterized by rapid declines in asset values, a reverse market crash involves an excessively rapid rise in market values, leading to potentially dangerous economic consequences. You see, what has happened and what's explained very well in these videos is you take examples like Argentina, Venezuela, Zimbabwe with massive amounts of hyperinflation caused largely by their own central banks for pumping excessive amounts of money into their financial systems, which creates inflation. And if you look at the charts, they display the charts in these videos. There's actually massive stock market rises during what we would consider to be very bleak economic times, because all of this money that's pumped into the financial markets, that's pumped into the economy, translates into a massive amount of inflation that we see within stock market values. Now, for our purposes, we're going to define money supply as M2. Now, M1 and M2, these are both Federal Reserve measures of the money supply in the US economy. M1 is money in circulation, checkable deposits in banks, things of that nature. M2, which we're going to talk about here, is M1 plus savings deposits and money market mutual funds. Essentially, it's very liquid money. Not stocks, not bonds, not real estates, commodities, just very liquid money. Money market accounts, saving deposits, etc. Now, take an example like 2008. The white line is the S&P 500, and we know that we started out 2008 around 1350, and then we saw a precipitous decline to the downside. Now, the black line represents M2 money supply. Now, the y-axis on the left-hand side, we see 77, 7800. Just so you know, these are actually denominated in billions of dollars. So we see as the market came down, we all remember what happened in 2008. The market came down, and then all of a sudden we saw a massive amount of money that was injected into the economy to help the economy survive and recover from this 2008 financial crisis. And as a result, March of '09, we actually had the bottom of the S&P 500 and many other indices, and then off to the races. Now, here is the same chart, but on a month over month basis. So it compares August to July and July to June. So it's just a monthly change. It gives us more of an equal sort of comparison. Again, white line is the S&P 500, which declined quite rapidly October, November of 2008. The black histogram bars in the background show us the money supply, which on a month-over-month basis in May really was, unchanged, up just fractionally. But all of a sudden, we saw massive increases in the amount of money that was injected into the financial system, peaking out at an over 2% increase on a month over month basis. Now, these are billions of dollars. So a 2% increase actually indicates a very, very large amount of money. And that helped the market find a bottom. And in conjunction to low interest rates, that created the environment for the next massive stock market rally. A better example of this is more recently because it happened all at once. This is 2020. This is the COVID stock market crash, March of 2020. White line S&P 500. We are at 3,400. All of a sudden, we saw S&P 500 3,400 drop down to 2,200. Well, the black line shows us money supply, M2, which is at 15,500. Again, multiply that times billions. But we saw a rather steady but slow, gradual move to the upside. Then all of a sudden, the Federal Reserve stepped on the gas, and we saw this 15,500 level reach 18,000. Take a look at the same figure on a month over month basis. February, we're basically unchanged in money supply. March, it began, and we saw a spike at one point of almost 12% month over month, but topping out for the April and May area around 6% month over month increase of money supply. Now, if we're a stock trader and we see the market going down, let's say we're short the stock market and we want to know how much more it's going to go down, or we're an investor and we want to wait for the bottom and try to buy as low as possible, we would look for a spike in money supply. Because a spike in money supply, you think about it, there's buyers and sellers in the market. Now, during a market crash, there's more sellers. But all of a sudden, you have billions of extra dollars that are injected into the economy, injected into the financial system, in conjunction with basically zero interest rates. It gives the market, it gives the economy a floor. And then we see the stock market all at once turn back to the upside. This coincides almost perfectly with a massive injection of capital, of money supply into the economy. Fast forward to present day. Well, the white line is the S&P 500. We've had a very choppy year, to say the least, hitting highs almost near 47, 4,800, lows near the 3,600. We're currently near the upper end. Money supply, we can see, has tracked pretty closely as far as the correlation is concerned with the S&P 500. As money supply increases, so does the S&P 500. But then you compare it on a month over month basis, there's actually virtually little change. Money supply has actually been very, very quiet as of late. The S&P 500, maybe not so much of a surprise, has also been quite choppy. This chart again is on a month over month basis for both measures. So while the S&P 500 on a month over month basis either vol is goes between a 10% and a positive 10%, positive 13%. Money supply is essentially unchanged. And if you take a look at a longer term chart, this goes back to the year 2000. Notice the yearly, these are annual changes in money supply. 2001, Federal Reserve injected a massive amount of money into the system, 9% increase on a year over year basis. 2008 financial recession, also 9% increase. The COVID crash, 24%. It really goes to show you how much money was thrown into the economy in 2020. 2001 and 2008 together is 18%. We had a 24% increase in 2020 and an 11% increase in 2021. But notice present day, 23, so far we actually have a 2% decline in money supply. Now, the reason that is, in part, is because of the massive hike in interest rates. You see, when the Federal Reserve raises interest rates, it pulls money out of the economy. You see, if we have, let's say, $10,000 in our savings account, and that $10,000 might be used to go shopping, to make investments, things of that nature, but all of a sudden interest rates go up. Well, the interest rates on our credit cards and our auto loans and our mortgages all go up. That takes money out of the system. It locks money up. And that's why money supply decreases. Remember, money supply is liquid cash, deposits, money markets. But if we're paying higher interest rates for credit cards, higher interest rates for home equity loans, that takes money out of our savings and our money market accounts, and it commits it to these higher interest rates. So that's why, in part, we've seen such a dramatic decline. Actually, not unprecedented, but a very unusual decline. Really, the second decline after 2022 in the past 20 years or so. So moving forward, what does this mean? Well, typically we see spikes in money supply after the market has started to crash. But the takeaway from this is that if and when we see a market crash, we're going to watch M2 money supply very carefully, because if we see a spike in M2, that might indicate that the market's found some sort of bottom. In regards to, many different, YouTube channels out there that have talked about a reverse market crash. Tell us what you think. Are we in the middle of it? Some would argue we're in a reverse housing market crash. Tell us what you think, though. Do you agree with this analysis, or maybe some of the other channels that say that this has already actually started? We're going to revisit this issue because it certainly is very timely and quite interesting. We hope this has been helpful. We look forward to seeing you back soon.